Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak, with over 15 years of commercial broking experience, focused on the middle market, upper middle market, national account space. The Wolf of PNC is a practitioner-led podcast designated to serve brokers, buyers, and carriers. Straight talk, no bullshit, nothing to sell here each and every episode. Topic for today is business income, and I've definitely talked about business income, but I'm going to talk about a cheat code that I developed for business income that I think brought logic to a somewhat mystical insurance coverage for buyers, but it only applies for really one type of industry. But I was able to do this very successfully throughout my career. And it's not necessarily a hack to save money, but I think when it comes to something like business income, which again is net income plus continuing expenses as well as extra expenses, it's on a property insurance policy. It's the second biggest number you think about outside of TIV. But unlike TIV, which everybody knows kind of has an idea of what the value of stuff is when it gets burned up in a fire, business income is always mystical. I've always said to clients, it's an art, not a science, because what you're going to need in a forward looking 12 months to cover net income and continuing expenses and this other slush fund of extra expenses after a devastating loss, that's not as perfect as what it is. It's not as easy to wrap your head around that as what it is to rebuild a tangible asset. So I found that I made a lot of my connections with customers because I spent a lot of time talking about business income, and I've done business income episodes. It requires you to be able to sit down with your customer and understand their business. It requires you to find the intersection between a financial document, balance sheet, income statement, and an insurance policy. For brokers out there, younger ones, this is where you can really shine, in my opinion. Specifically, if you work in an industry like manufacturing or distribution, where this number is incredibly important. Buyers out there, I think this is a great way for you to understand if your broker knows what they're doing. I've said this before. If you get one of these shitty business income fillable worksheets from the major carrier that's supposed to guide you, and that's all you rely upon to develop your $50 million business income limit, that is not good. But I've done an episode on this. What I want to talk today about is a cheat code or a hack that I had for a very specific niche of business. And the niche of business that I'm talking about is distribution companies. Let me qualify that a little bit. When I say distribution companies, I am not talking about widget makers. I'm talking about companies that are value-added distributors. So I'm a broker. I'm taking products from Travelers, Chubb, CNA. I am bringing it in-house. I'm putting some fairy dust on it. I'm adding whatever my value is, and then I'm selling it to the client, and I'm collecting a commission, or I'm marking it up. Well, in the distribution space, I'm not making the product. I'm buying wholesale and I'm selling retail. There are tons of distributors. We used to work a lot with food and beverage distributors, beer distributors, liquor distributors. I worked a lot with equipment distributors. And again, they weren't making anything, and they weren't necessarily doing any modifications to the product. They were just buying wholesale, selling retail. A lot of the major manufacturers in this country, in this world, they don't have the infrastructure set up to get into every Home Depot, to get into every Walmart. They want to sell to a warehouse, a distributor, and then they want to have that distributor then mark the product up and then sell it at retail. Think about the gas station. There is a distributor, a wholesaler that comes in and puts all the snaps into a gas station. There's a guy that represents 15 brands that populates all the aisles of the gas station. That's a wholesaler. They're buying wholesale and then selling it to the gas station retail. All those things are marked up along the way. I worked a lot with distributors in my career, specifically big ones. They have some very key exposure risk profiles. They usually have larger fleets. They usually have what's called a distribution center, or a DC, meaning they have a hub where they take in the wholesale purchases of whatever their widgets are, and they're going to hold them there, and they're maybe hedging, they're maybe they're buying early, but they're keeping stock and inventory in a racked warehouse, and then they are selling it to all their retail type customers. When you're a distribution company and you think about business income, again, net income, continuing expenses that incur in the absence of the loss, and extra expenses, a slush fund. My example is always putting a fence around my burning heap of a building. Net income is, let's just call it profit. Profit. Let's think about profit when it comes to a manufacturing company. If my manufacturing facility burns down and all of my CNC equipment is burned down, I can't make the widget which generates profit for me. Okay, understood. I therefore am going to need to cover my net income I'm going to need to cover my profits until such time I can build a new facility and get new equipment and start making widgets again. Well, let's think about a distributor. A distributor has this warehouse, but really all they need to do is put another order in. If my warehouse is a distributor, if ABC Warehouse Supply, who sells primarily widgets, my warehouse burns down, I don't need equipment to make more widgets. I just need a new warehouse, or I need the ability to, my wholesale partner, drop ship to my end customer who's putting orders in. It's just a moment in time. I don't necessarily have this unknown long lead time to where I can produce widgets again. I just need space to drop the shit from the wholesale partner so I can resell it to my retail. I'm just a middleman. So one of the things that I did very successfully, and again, depending on how you structure your limits, this isn't going to necessarily save you premium, but it's going to make something make sense. Brokers, buyers are frustrated with business income because brokers don't do a good job of explaining it. And it's whimsical. It's an art, not a science. There's nothing exact about it. Not to mention, they're forced to do these worksheets and sign their name for a number that they realize is important and critical, but no one's spending the time to go through it. So one of the things you can do as a broker to really accentuate your value is to come up with ideas that make sense. Make it make sense to them. And for distributors, this tactic that I use seemed to make a ton of sense. So understanding that I don't need to have the ability to fund for 12 months of downtime if I am a distributor, here's what I would do. I would say, look, all of my product, my profit in any moment of time is locked into the product that I purchase, the widgets that I purchase wholesale that I have yet to sell retail. I'm buying, let's say I mark it up 20%. So I buy widgets at $80 and I sell them for 100. My warehouse that burned down is full of $80 widgets that I've yet to sell for 100. So the first thing you do is you say, I don't need as much business income and extra expense limit because I am going to, and most of your insurance policies already account for this, I am going to enact, or I'm going to use, or I'm going to value all of my stock held for sale at sell price, meaning your distributor customer now is going to collect sell price in the event of a total fire. So all of the widgets they paid $80 for, they're going to be able to collect 100. Another byproduct of this is it's a hell of a lot easier to get paid out from an insurance carrier on tangible property. When you can say, I had 50,000 widgets here that I paid $80 for, and here's my average selling price of that widget over the last year at 100, it's a clean claim. It doesn't involve forensic accountants poring over financials about what I would have made. So now I'm valuing my widgets, my profit. I'm putting my profit into a tangible asset that I know I mark up. I'm going to value it at $100. Now, the key is here, your policy might already include selling price for stock held for sale. And most brokers and most customers aren't filling out their TIV to include selling price. So if you're doing this the right way, and this is the thing that I always had to counsel clients is when I fill out your statement of values, you actually have to insure your stock at selling price. So what you can't do is say, I bought it at 80, I sell it at 100. I want to collect at 100, but I'm only going to insure it at 80. Yes, you might have a big blanket. You might have multiple locations, but in order for an insurance carrier to accept this cheat code that I'm talking about, you got to put in your statement of values. You got to put your stock held for sale at the selling price. And then make sure your policy includes stock held for sale at selling price. Once I've taken that profit off the table, now my business income calculation becomes a lot easier. That's the biggest nut for any company is making sure that that profit's there. So now I need to go through and I take out the balance sheet and the income statement and I say, what are my expenses that would continue in the absence of a loss that aren't supported by the profit of the company that I've already insured in the tangible assets? And then, yes, I have to pick a number for my slush fund, my extra expense. For distribution companies, most of the time, this is going to be expediting of new product to get to the customer because I had product burn up. I need to expedite new product to the customer, either a drop ship. I'm probably going to need to rent a new warehouse or a distribution center. But these numbers fail in comparison. I had a client that was well over $100 million in distribution sales, kind of in the Home Depot type product space. And we got to the point where they had enough redundancy. They had the ability to ship to satellite locations. We put in a paltry $3 million business income, extra expense, limit of insurance, because we were insuring all of the profit in the tangible assets that we had a selling price clause within our property insurance policy, which we knew in the case of a fire would be a lot quicker of a settlement And the client loved this because it made sense. You might get some pushback because underwriters don't have this level of creativity. They're like, oh, well, what about my business income worksheet? And that doesn't necessarily look right. You have to explain this concept to your insurance carrier. And once I explained it to my insurance carrier, I was able to get them on board. Now, they wanted to make sure that the value of my stock held for sale was actually valued at selling price, not valued at replacement cost. But once they did, they said, this actually makes a lot of sense. Now, if you do this, you need coinsurance waived because showing up with a $3 million business income limit to a $150 million company with $20 million of net income, you could run into coinsurance. So all of the times that I successfully did this, I had to explain it to my insurance carrier and I had to make sure that they waived and had agreed value. Do I think this resulted? I mean, property rates, hard tangible property and business income rates, it's usually the same rate. So are you trading it? Yes. But the important thing here is you're taking something, business income, that is wildly misunderstood and unexplained, and you're making it something that can be understood. The more you can educate a customer and help them understand their business so they don't feel like they're just paying in the wind, the more you're going to have a customer that sticks to you and that you find that you're aligned on making the decisions that you otherwise would have made anyway.